right, hey, welcome everybody. Today we're going to talk about how our natural thinking patterns can affect our investment decisions and what we can do about it. So studies have shown that the way we think and feel about money can lead us to make choices that may hurt our investment results over time. So with markets reaching new highs after 2 years of good performance and really like 14 years of good performance in the S&P 500, it's especially important to understand these natural tendencies. So many people make mistakes like selling when prices fall or becoming too confident when the markets are doing well. So in the next few minutes, we're going to look at why people sometimes make investment choices that may work against their long-term financial success. Okay, so let's start with what the experts call recency bias. So what this means is giving too much weight to what's happened lately rather than looking at the big picture. So for example, some investors might focus too much on how well the market did in 2024 while forgetting about other factors. When we pay too much attention to short-term events, we might miss bigger trends that shape market performance over many years. So one thing I do want to bring up again is that S&P. So from January 2000 to December 2009, you actually had a negative return. But the last 14 years, it's done very, very well. But let's go back here for this example, back to the 2008 market downturn and show why this matters. So from this chart here, as you can see, there's three different lines, okay? One shows people that just bought and held. The second line showed people that actually moved the cash for 1 year, okay? So that's our yellow line, and then reinvested. And then the red line is somebody who just moved the cash and left their money there. So the 2008 market downturn, like I said, shows why this matters. So people who kept their money invested ended up doing much better than those who moved the cash, even for a short time. So instead of reacting to every market move, it's better to stick to a long-term plan that matches how much risk you're comfortable taking. So this chart here shows what would happen if you had invested $100,000 and held onto it for 20 years. If you did that, you'd end up with more money than if you moved the cash during the market drops. So if you look at that blue line, it shows there if you had the $100,000, it actually turned to over $1 million, $1,056,850 if you just left that $100,000 there for 20 years, which is pretty crazy if you think about it. If you took that money during 2008 and moved the cash for a year after things crashed down, you can see here you'd only have $642,587. And if you just left it in cash, you might have $146,269 if you put it somewhere that'd be like a high yield savings account of some sort. So it's really important to really think about the long term when it comes to your investments. So looking at this chart, we can see why staying invested during markets ups and downs is so important. It shows what happens when investors take their money out of the market for different periods after it drops by 2% or more over the last 25 years. Many people want to pull their money out when markets fall because of something called loss aversion. This means that losing money feels worse than gaining the same amount feels good. So think about it this way. Finding $10 feels nice, but losing $10 feels really bad. The fear of losing money often causes people to keep too much cash or sell investments when prices fall. But history shows that patient investors who stay invested during market drops usually do better in the long run. In fact, the very reason investing can be hard to stick with is exactly why it can pay off over time. So this is really important actually, because what I find is the difference between people that are successful with investing over time and those that struggle are really the ability to tune out the noise and just forget about it and just let the money work, right? So the last pattern we're going to discuss is called home bias. And this is what happens when people prefer to invest in companies from their own country instead of looking at opportunities worldwide. Some investors even limit themselves to companies in their local area because it feels safer and more familiar. However, this approach might be missing out on chances to spread risk and potentially earn better returns. So while U.S. markets have done better than international markets recently, investing in other countries can offer good opportunities. International markets often have lower prices and can help reduce risk by spreading investments across different regions. Understanding these natural thinking patterns and sticking to a long-term plan is key to reaching your financial goals, rather than making decisions based on emotions. And if you look at the valuations of the US versus international right now, international is actually a very, very good value. Does it mean that they're going to outperform? We don't really know. But at the end of the day, this is something that when you have a good balanced portfolio, you have money invested in different places, you're generally going to be better off over time. So we hope you found these insights helpful. If you would like to learn more about any of these topics, please don't hesitate to reach out. I would love to speak with you personally. If you're somebody who is working on getting your investment portfolio in place and you want some help managing that, we're happy to speak with you. You can go to keepitsimplefinancial.com/talk. Once again, my name is Jason Hamilton, and I look forward to speaking with you soon. Have a great day.